Hello, I'm Grace. In May, South Korea's money supply, often described as the lifeblood of the economy, saw a record surge that exceeded market expectations. Looking at M2, or broad money, a massive 32.2 trillion Korean won, approximately 23.5 billion USD, flowed into the market compared to the previous month. This marks the steepest increase observed in about 9 months since August of last year, highlighting a notable expansion in market liquidity. M1, which represents narrow money, also rose by 1.9% from the previous month, indicating a capital increase of 26.2 trillion won. In particular, demand deposits, which can be converted to cash at any time, grew by 24.3 trillion won, hitting a record high since statistics began being compiled in 2003. The primary driver behind this spike in money supply was a 30.1 trillion won inflow from the non-financial corporate sector, rather than from households. Analysis suggests that cash flows from major semiconductor firms, such as Samsung Electronics and SK Hynix, drove money trusts with maturities of less than 2 years up by approximately 3.8 trillion won. Comparing these trends through the lens of corporate versus household asset structures reveals a distinct polarization between economic agents. While the corporate sector increased its liquidity by securing vast amounts of cash, the assets of households and nonprofit organizations actually decreased by about 19 trillion won. This can be interpreted as corporations hoarding funds for aggressive investment or operations, while households face shrinking capacity for both consumption and savings. A fact check of the changing nature of these assets confirms that corporations are focusing on short-term management rather than long-term investment. The record increase in demand deposits suggests that companies are prioritizing the securing of margins that can be deployed immediately to prepare for market volatility. Ultimately, the current increase in money supply appears to be driven more by the need for short-term liquidity for financial transactions rather than the revitalization of the real economy. A significant portion of the statistical rise is due to corporations building up large reserves for derivatives or securities trading. This phenomenon can be read in the context of corporations making cash preservation their top priority to prepare for future economic uncertainty. In conclusion, a distorted liquidity structure is intensifying, characterized by a simultaneous concentration of funds in corporations and a decline in household assets. The key question moving forward is whether this abundance of short-term corporate cash will lead to actual facility investment and employment, or if it will merely fuel volatility in the financial markets. I'm Grace, thanks for watching.